oil is back in fashion. And I think there's enough justification now for the big companies and governments to not receive as much backlash as they have in the past about supporting oil and gas. So I think personally, the oil and gas licenses will continue to flow in the US and the UK and Europe. Hi everyone, and welcome to the first episode of 2024 of the World of Oil Derivatives podcast. I'm your host, Greg Newman, Chief Executive of Onyx Capital Group, and today I'm joined with Martha Dowding and Vincent Wu for a market-focused podcast to start us off. With the new year, traders, market analysts, and market observers are looking for a new consensus. Research houses are making their claims, banks their forecasts, and it will be still 1 to 2 months before we hear from trade houses and majors about their outlook for the year. So far, it might be a new year, but new themes are lacking. We have to remember this is a market that likes to be long, likes to be bullish. I've been in the conversations with government agencies and market analysts at the end of the year, and there's an acknowledgement that we have enough supply, but yet we will be balanced because of, you guessed it, Chinese demand. Now, this is a deeply tired narrative that has been used with no exaggeration for 20 years. Critics of this narrative will point to a worrying Chinese economic outlook, foreign investment having fled almost in its entirety in 2023, and surprising increases in Chinese own domestic oil supply. That all said, we didn't get the promised recession for 2023, and as one trade house economist said, high cash, low debt, and strong factory data are not recession signals. So could the global economy surprise us to the upside this year? Could we get lower interest rates that bring on a risk-on move in macro markets? Or, as always, could there be a geopolitical conflict that genuinely does impact supply? On this podcast, we'll talk and address all of these themes, but we will also go into the depths of the micro elements of the market, the real signals of how market sentiment is evolving and the forward physical market is playing out. Now, physical oil differentials, time spreads, refinery margins, arbitrage differentials, trader positioning, trader entry levels, these are all part of the market minutiae that you should and can be aware of. We are here to bridge that gap of knowledge and awareness to level the playing field, and we'll be bringing you much more content throughout the year to assist in this ongoing journey of evolution in oil markets. So, Martha, can you start us off with how Brent Futures prices have been playing out since Christmas?
Yeah, of course. So since Christmas, we saw prices peak at about over $80 a barrel on the 27th, and then since then we've been sliding down a bit, and then just focusing on the past week, prices rose up to about $79 a barrel. People, just as you said, just wanting to be long, started the new year off with the same kind of places they're happy to be. And then on Thursday the 4th, we saw a liquidity event after the EIA stats release. We saw what would appear to be a pretty significant draw in crude. We saw a 5.5 million barrels in crude, but then a really significant build in the fuels of distillates and gasoline, but also a build in Cushing, which is often a lot more representative of the supply and demand situation in the US. So traders will often look at that, whereas the headlines will be huge draw. Why is price crashed? But there was that build in Cushing. But also, I think a little bit later we are going to talk about how these builds in distillates and gasoline are not super reflective of the market. So we'll come back to that later.
And CFTC report?
Yeah, so CFTC report for the week to January the 2nd. The 2 weeks of bullish trends in the Brent and TI were reversed, and we saw a 24% decrease in net positioning for both of those contracts combined in the week. Brent saw a 30 million barrel increase in short positions in the week, and WTI saw a 36.5% addition in short interest, which leaves the TI long-short ratio into the third percentile for all weeks to 2013. So looking at pretty bearish. Looking at Prod Merc, we saw a pretty significant removal in both long and short positions in Brent as well. So pretty risk off from them.
Okay, and that's a good summary. I guess we can dive a bit more into it. But what about, we can call this the Googling oil segment, right? So when you just put oil into Google, what's been going on, headlines. Vincent, do you want to just summarize?
So as you can see on the screen here, first we got a headline from the FT. Oil dropped sharply as Saudi price cuts overshadow Middle East tensions. So despite the geopolitical risk premium surrounding the Red Sea, the Houthi attacks, over the festive periods. Crude prices have fallen, and over Sunday, Saudi Aramco has lowered their OSP to Asian customers, indicating a very bearish sentiment, bearish demand, and has spawned conversation that perhaps Saudis are in a real dilemma with OPEC. Perhaps this year they might be gunning for more market share as opposed to cutting prices, which has not seemed to have yielded results they want. So with OSP stands for official selling price. So essentially, it's Saudis have they produce various grades of crude from light to heavy, and it's essentially a differential against the Omani crude benchmark. It's either premium or a discount. So usually these days it's around the $2 to $3 premium. So whatever the price the PRA set, it's at a premium to it. So similar to like the North Sea benchmark, the crude grades from the Brent basket are priced as a differential to data Brent.
Yeah, so it depends on the region, right? The benchmark for Europe, benchmark for Middle East, benchmark for US, and they set their prices. So this is a 24-month low for the prices relative to the benchmark. So on absolute terms, it doesn't have to mean a huge amount, but I think because it's been so long since they've done this, it is quite clearly a market share move. And you mentioned CityAM, good, thanks for the plug. So I did quoted for them just when they asked about it, and that was exactly my view. It's like the Saudis are pushing other members to share the burden. Like that's pretty obvious from the last meeting, and I think it's like trying to get some urgency, right? Like if we don't cut, if we don't get involved, I know you guys all want to bring back production, but oil's teetering on the edge here, and also they've been doing so much for so long. So if they want to turn around and make this a market share game, we know the Saudis don't mess around. Everyone knows the Saudis don't mess around. So this is as good of a warning sign as I think you could get from the Saudis to kind of either fall in line or maybe expect that if things are going to fall lower, if it is going to be about market share, they're going to fight as hard, if not probably harder than anyone else to establish themselves. So that means if it comes to that, we could have pretty severely low prices pretty damn quickly. But I don't think anyone wants that. Maybe not even the kind of US government, because even in April pricing war, Trump had to get involved, right, and say, why don't you guys stop this, come up with an agreement and actually bring oil back into balance. And that's a US government, so it tells you a lot. Like even the US government, of course, they have their own domestic oil supply. There's a lot of jobs, economies that get destroyed when the oil prices has a collapse. So no one really, I think, wants that. So that's a good one. Any other headlines?
Yeah, another one comes from the BBC. Oil and gas legislation is total distraction, senior Tory says. So former Minister Sir Alok Sharma said he would not vote for the upcoming offshore petroleum licensing bill. So that comes after ex-Net Zero star Chris Skidmore announced he was quitting as a Conservative MP over the legislation. So it's a debate about the UK's energy security, whether or not to announced to approve new permits for North Sea oil and gas exploration, and also comes at a time when Labour announced that there'd be no new they announced no new permits for North Sea oil and gas production, and also that's what just up oil demands, and of course it's an election year in the UK as well. So
I was going to say it might seem very niche for like a wider oil audience and people we know listen in the US, but it is relevant because UK see themselves as at the forefront of renewable shift, and especially Labour, right? The Labour Party expect to get in at the end of the year, and they expect to be borrowing, up to 20 billion, maybe more, pounds to push forward with, renewables and the head towards net zero. So, like the rhetoric around it, as you say, it's election year. So I think I read something as well this morning about. Investors, obviously bond markets and just in general, are getting pretty worried about all the borrowing that's happening ahead of the elections because they want to look good, right? The governments want to look good. They want to spend something now to make it look like they're doing something. And that's, we're already at like ridiculous debt levels in the US and probably Europe as well. So it is all relevant, like the discussion around this. So this is quite a clear stance of, whether it's to get votes or it's an economy thing, it doesn't really matter. The point is that there are enough people out there, and clearly in the Tory party, who have kind of ridden this shift away from, let's say the beginning of 2022, when the renewable narrative started to die a little bit. And they're saying, look, if we're going to be serious about this shift, even in 2050, fossil fuels are going to be a big part of our energy system. It's better that we secure it domestically than not at all, which sounds pretty pragmatic, but you just can't really know what's behind it. And I guess that's the problem. But for me, it's the wider theme of oil is back in fashion. And I think there's enough justification now for the big companies and governments to not receive as much backlash as they have in the past about supporting oil and gas. So I think the oil and gas licenses will continue to flow in the US and the UK and Europe. But that's pretty much all there is to say about it. It's just a rhetoric thing. But Martha, you want to add anything?
I think just looking, as you say, it's an election year in the States as well, and them refilling the SBR now, that's going to be a hugely strategic move for them. I know that retail gasoline prices across the country are at their lowest in like a really significant amount of times. And if he's able to pull that off along with refilling the SBR, which everyone has always said, he did it to get lower prices for everyone, it's just like a cheap cop out. I think if both of those things continue to be true, they will be really important to like keep an eye on. Yeah,
for the Biden administration, that could be really significant. I see what you're saying. It's like the inflation gone way down, oil prices way down, economy maybe even starting to boom again this year, which I think for me is very, very key, because as I said, like at the beginning, Chinese oil demand, that's not a compelling argument for how we, soak up all the excess this year. But the global economy is. And I think, all the talk we had about people literally pricing in recessions all last year, and we didn't get it. And then you've got people pricing in rate cuts this year. So maybe getting too over optimistic, I don't know. But either way, if we do have things stabilizing and we go on a decent stock market rally, then it's a good argument for buying flows to come into oil. And no matter what you want to say about fundamentals, supply and demand, we're going to say it until we're blue in the face, right? I mean, prices are set by the collective sentiment, collective positioning of traders that can trade Brent and WTI futures. And I think given at $78 per barrel, 75 maybe now, you have a rush in of buyers from risk parity, like managed money flows, or just general traders reacting to economic signals, then that will drive prices higher. It's as simple as that. So that's probably the best bullish argument we could probably give right now. Do you agree?
Just depends on positioning seems very saturated to the sell side, at least in futures money managers. So any bullish headlines could really exacerbate a move upwards.
Yeah. No, exactly. I think what we put on our report yesterday was homeostasis, right? It's got that on the upside, but then the upside's kind of capped because any supply headline that's coming out, the market is reacting quite bearishly to, as in, like, for example, the price cut we just saw was followed by a $2-3 barrel sell-off on Brent. I think the market is expecting to see oversupply headlines and will react accordingly, but I see your point. One of the signals will be, just like it was the reverse last year, every time we get one of these headlines and the market doesn't react as much towards the downside, that's a further indication that we're more saturated, a further indication that any more bearish news can't really be taken. So it's a really difficult one, unfortunately a really boring kind of outlook in a way, because there's not much reason to be excited on the upside, but it's also hard to be that bearish because ultimately we are in the middle of an artificial cut, and there can still be extreme moves made. So it's not a great one for deciding direction. And but we should talk maybe more about the geopolitical macro stuff. As I said, we want to like engage people. So Martha, what about outside of like the recent headlines, just general themes happening? Japan earthquake, for example.
Yeah, so on New Year's Day, there was a really significant earthquake on the west coast of Japan, and this led to shocks and a tsunami over a range of cities, like a death count, a really like awful event to happen to start the new year with. So its impact on the oil market has been fairly muted. When we talk about Japan, we often talk about petrochemicals, we talk about certain distillates, and we haven't really seen a very significant impact here. I think from what I have seen, the petrochemical plants are all tend to be on like the south coast of the country, so that they can be like easily exported like the rest of the world. So they weren't so significantly impacted just purely by location. I know kerosene hasn't seen a hugely significant impact of this at all, but it does remind us that we're all at God's mercy, and any of these things can happen. I know the hurricane season, tornadoes, the chill that we're having in Europe at the moment is going to be a pretty significant thing. I know all the nat gas bulls are going on about it, but I think this specific incident, although tragic, hasn't had a huge impact on the markets at all.
Yeah, I think for oil market participants, especially if you've been in the market, what's it now, 15 years odd, you'll remember the Fukushima disaster. You guys won't remember, obviously. Were you alive? Yeah, you were alive.
No, I don't know.
So yeah, I mean that was such a big event. It took nuclear power off, at least from Fukushima, for at least I think a year, and so they had to replace it with low sulfur fuel oil. The high-low, so that's the low sulfur residual fuel oil versus high sulfur. So the high sulfur at the time being used for bunkers, low sulfur for power generation. That differential obviously skyrocketed, and quite a few fuel traders had great years off the back of that. Maybe some others didn't. But the point is that it's the first thing you think of, I think, in the oil trading community is always this kind of Fukushima type scenario. But the answer, I guess, is no. And I think every time we get these things, it's just telling us, or at least tells me, that since post 2014, I think we went into a shift of a net, demand increase and an undersupplied market to oversupplied market, and possibly not getting the demand. So we've got very robust supply and very well protected supply. So it seems like every major importing country and exporting country is very well prepped for basically geopolitical situations or disasters. I mean, Saudi Aramco got literally bombed and it didn't have a material impact past 2 days. We've had, endless kind of disasters. We've had wars, and it's just not the same market as pre-2014, which probably drives the kind of veteran oil traders nuts. And you got like the guys who run hedge funds, who've been in the market, 15, 20 years. They like a bullish market. That's kind of where they cut their teeth. So I think it's quite hard to accept when you have all these things going on and then the market doesn't really react. And I think one person from a bank with the it was in the Israel-Palestine conflict when we were talking about it last year. I think going into the weekend, we did get a rally, which you'd expect because you don't know what's going to happen and you want to cover your shorts. But there was just overhype. It was like, I think someone said in the FT, like, you would have to be nuts, or no one in their right mind would be short into this conflict. And actually, that's not true anymore. You can easily be short into these conflicts because there hasn't been one in the last almost 10 years, coming up to 10 years now, where there hasn't really been this like shock kind of impact on oil. Even the Aramco one. I remember Aramco, when it got bombed, it happened over the weekend and it gapped up $10. And I even remember like some people saying, like, if you're short, it's going to be dicey, but actually you'll probably be all right. And to even say that, it's crazy. We were $60 per barrel, went to 70. People were saying could easily be 100, 110, but it went to 70 and kind of drifted its way back over the next couple of days. I think it even went even lower than it kind of was going into the weekend. And that just shows you, as you say, Martha, it's like not that nice talking about like all these events happening and what about oil trading? But at the end of the day, it's just objective thing. The market doesn't react to these events anymore. So you can't just slap on a headline and say there's something going on around the world, buy oil.
It doesn't stop them.
No, well, yeah, I mean, they might do it, but it doesn't actually work out. And actually, that leads me on to the other kind of big thing that's going on, which is the Alaska airline flight incident, which another great move for Boeing. They didn't really learn from their catastrophic failure with the 737 MAX. They've had a door blowing off. It's a slightly different model, I think. This one, it's not the 737 MAX, but it's Boeing, generally speaking, aren't doing too well. Their stocks are being hammered, and I think no one was hurt. But
the two seats that would have got whipped out into the sky, they would just happen to be empty.
Oh wow!
Isn't that crazy?
That is crazy. That is nuts. But anyway, the point I was going to make was these kind of events. It reminds me now. This is when I wasn't trading, But in 9/11, I heard, like my last boss was saying, he was trading. I said, what do you do in an event like that? So pre-2014, again, like generally speaking, you've made your money being long. There's been a big bull market. When anything happens, aliens invade, you'll go buy oil, right? Because it's just like instinctively, you're like, well, if something's going to happen, it's probably going to be in the upside because we're in a net scarce, net bullish market. And that's kind of shifted. So at 9/11, again, my boss, Alf, he was saying, he just picked up the phone at the time. It was, I think, more manual phone calls, and just bought futures because you see their planes crashing, you think war, and you think, okay, buy. But then I think actually another guy who used to work at Onyx, he was in the pit at the time, pit trading. Everyone was buying. I think he was short, and obviously you just don't know what's going on. So people are kind of covering, and then they suspended trading. And then when everyone kind of realized what was going on, all the planes were being downed, and obviously jet demand was going to take a massive hit. People weren't going to fly, like pretty much overnight. Stocks were getting destroyed. They reopened, and it just completely reversed. Everyone started selling. And that's kind of like the nature of like when something uncertain happens, do you just knee-jerk buy? I would argue probably still, as you said, Martha, like you can't stop people just buying out of fear for some reason, but actually it does, I think now tends to not have an impact or actually be kind of long-term bearish. Any thoughts on that?
I would say that in the last 2 years, the Russia-Ukraine thing did have a massive influence on commodity markets, but yet I suppose it's still the same as you said. Prices are lower than what they've been before. Natural gas prices slightly higher, but crude futures are definitely below what was.
Oil in particular. You're right. Commodities obviously did perform, natural gas and things like that. But again, in the Russia crisis, the invasion, leading up to it was where the real bullish things were going on. Right, the draining inventories were, a post-COVID production cut, and OPEC weren't bringing the oil back online, and claiming there wasn't enough spare capacity. It's like absolutely nuts. Everyone was believing that. And then prices just were skyrocketing into the war. And I think, again, what do you do in a war? You buy. And it's illogical. You expect supply to be cut, and I guess sanctions could have been cut. But there wasn't really any material difference in any oil supply. It's kind of going back to my same argument. Did oil stop flowing? Like, no, right? So you were having this big rally up to the invasion. Then you did have a massive spike kind of temporarily as everyone kind of binary bought out of uncertainty, out of fear, like I was saying before. And then ultimately we finished lower and people couldn't get their heads around it. So, but it should be higher. What's going on? Well, the damage has been done, right? Inventories were already drained. And if anything, you needed to produce more oil to fund the war from Russia and sell it. And oil was flowing like mad. Like it's kind of just encapsulates the point.
Yeah, I think initially, there were talks about what if Russian flows come offline, but ultimately do not really have too much of an impact. But a lot of speculation and how that affected people's S&D models was like how much, to what extent, how many million barrels per day of Russian oil coming offline, and how that would affect the market. Mm-hmm. But I'm not too sure about the numbers right now, but all of the talks about sanctions or the price cap, or what the Western governments wanted to do, increasing their sanctions on Russia, that did have a material impact, at least on the sentiment.
A knee-jerk reaction to buy, and then what happened?
Ultimately,
it was like it's going to go to 300. It didn't. That's what I'm saying. It was still embedded in people to buy oil when things go wrong and things are uncertain, and that hasn't worked out.
No.
Stop trying to argue with me, Vincent. I'm joking.
Debate.
Yeah, I know. Well, to further that debate then, Red Sea attacks. Again, like we were kind of almost too blasé, like, another thing that's not going to have an impact. But it is a serious trade region. So, Martha, there has been a bit of an impact, right, in the minutiae, not in the outright prices, but in the minutiae of the oil market.
Yeah, definitely. I think, looking at freight specifically, and therefore very freight-dependent contracts, so the TC5 freight is the one most impacted as it goes literally through that area. That skyrocketed, bringing up with it the naphtha East-West, well, not completely one-to-one, but it's been a massive impact on that. You saw the correlation really increase during that time, that it was just before Christmas when the freight was increasing at its highest. magnitude. But then since then, we've kind of seen it relax a little. I know that Vincent, you've said something about Brent TI diff.
Yeah, WTI Brent did come off substantially from -4 to low -5, almost -$6 per barrel. So that's the difference between the WTI US and Brent, the
European.
Global.
Well, yeah, global, but it's a real arbitrage now, right? Because if as long as you can get it from Cushing to the Gulf Coast, because Brent has WTI Midland setting it, it's a genuine real arbitrage. Like it's got a lot more meaning now, that level. So when it's -6, usually it was around -4, -3 last year. -6 is basically saying, look, the price dislocation has to weaken enough to incentivize people to actually buy WTI and move it over. And freight is really expensive, and there's a scarcity of ships and hard to insure ships or whatever else. And we've got the Panama Canal situation, by the way, for the whole NGL scenario. I know it's not directly linked to crude, but it's just generally, pressure on kind of freight and shipping around the world. Then freight prices are going up. Charterers are saying, yeah, cool, we're going to raise our prices, and it's justified to do so. Therefore, that makes the arbitrage more expensive. So the WTI Brent widening is logical, right? And it can continue to widen if freight continues to rise. So I would say that it's definitely got some potential knock-on effects, the Red Sea on the wider market. And if freight is sustainably expensive, and the Red Sea is sustainably like difficult to move all around, which it doesn't look like it's the case right now, but you never know, it could escalate again, then I think it will be more material impacts in east versus west contracts. I think NAPFA did have an impact, but it may not be immediate because things might be okay. People might see it as temporary, but like we saw with the Russia crisis, you can have the need for real structural changes in oil flows when there's a sustainable geopolitical impact or sustainable disruption to trade flows. So it's possible, and the freight market does look very like all over the place. So I think that's worth saying. Okay, so if we could move on from kind of macro headlines, get more into the micro then, as promised. So Martha, refinery margins, how have they been changing recently?
Slight improvement week on week, 24 cents a barrel from the 1st of January. This is pretty much being dragged down by EBOB weakness. We've seen EBOB get absolutely smashed recently. We've seen the EBOB crack down to like $8.60 a barrel this morning, from highs of around 11 at the beginning of the month. So at the beginning of the podcast, we did mention these builds in inventories and the refined products in the US. So there was a 10.9 million barrel build in gasoline inventories in the States, which is absolutely huge and the largest in 30 years. So, of course, one could assume this would be naturally a really massive bearish driver. But Vincent actually mentioned this in a video that he did the other day. The fact that there is such a low inventory for crude but such a high inventory for products is a bit of a tax, what word should I use, a tax get around, Vince?
Loophole.
Loophole.
Quite the euphemism, get around. Right, so actually, so if we look at the chart here, so yes, it was the largest build in 30 years, but
so this is every year in December.
Yeah.
I think it was interesting to see. I was talking to the trader the week before, actually the day of this happening, and he was saying that in the RBOB market and therefore impacting the EBOB market at the time, there was loads of macro money, and so the massive impact in the massive reaction was the kind of macro money seeing the headline rather than reading into the minutiae of the market and then leaving their positions. He said you could tell it was macro money because it wasn't very responsive to anything. It wasn't very responsive to weak underlying fundamentals. We've seen rubber higher than it quote unquote should be. And then we have seen, so you can see this huge drop off in rubber from the 4th onwards as the stats were released and the macro money ran. So yeah, that was interesting. It's interesting to see the impact of what the market's made up of, and I know we use our CP data for that a lot. Yeah.
So yeah, I mean, generally speaking, margins, Europe looking quite healthy, to be fair, and Asia, as always, they've been pretty strong for quite some time now. I think the key consideration this time is that actually the forward curve. So the forward curve for refinery margins. So you can imagine you're a refiner, you're looking at the outlook, and getting into 2025 is a different thing. But for most of 2024, you've got pretty healthy margins. Between 650 down to about 450, which by any estimation, you're not expecting more than a few dollars per barrel for costs, especially if you're well run and well positioned to yield kind of the higher value products. So I think we have been getting recently quite a lot of refinery hedging. I think the DFL in particular has had quite a lot of support. So that's the dated Brent contract. You've had some refiners essentially buying that up to guarantee prices on crude relative to products. And as you said, gasoline has been quite weak. I think you can couple the macro money, like you're saying, with also people rushing in on the refinery side to hedge, quite liking the levels. Because for a long time last year, particularly NAPFA, for example, NAPFA had very weak year in 2023 before rebounding towards the end. So I think being a waste product, being a negative to Brent, NAPFA, you'd probably be quite concerned about it dipping again, and it is starting to trend south. So I think the light ends in general, it makes sense that you would try and lock that in down the forward curve and kind of guarantee supply. At the end of the day, if you look at the light versus heavy crude complex, it's shifting so much, and we had a negative Brent Dubai for a lot of last year in the midst of OPEC cuts. That's now positive down 2024, and it looks to be kind of on a bullish trend. So lights are more expensive now, and I guess basically saying the same thing. It's a good market to hedge for refiners, and particularly as we don't really have any. I don't think many people have much of a view either way, and even with distillates, usually people have a pretty strong view on distillates. It's the same thing as flat price. It's the same thing as everything. No one's got really that much of a concrete view either way. So that's a great time to hedge in uncertainty. So if that does happen, we're kind of locking in pretty decent conversion of what supply is out there on crude into products. So I think we could expect, at the very least, inventories will be building in crude. I think that's expected, but products as well. Where it's been scarce and more on the lower end, say for distillates, it could probably pick up this year, which is kind of good for the end user, I guess, in terms of stability of supply. But what it does to prices, I guess we're not too sure. The only macro theme that I thought was interesting was jet prices relative to diesel prices. So in Singapore, this would be the regrade contract. So Jet Kero, Sing Kero versus or Sing Jet versus Sing Diesel or 10 ppm. Prices are very wide at the moment, i.e. jet is quite a bit more of a premium to diesel, and I think that's a very bullish sign in general for distillates. Airlines, and sorry, getting to the macro theme was my point, is that airlines it'd be a lot more of a struggle for them to switch to electric or anything other than oil for the near term. So the relative demand to diesel as EV cars kind of come more and more in, that makes sense for that differential to widen. That's probably the only other thing that's kind of interest in general. Just to repeat, like we talked about flat price not really having much of a concrete direction either way, and it's the same with products, the same with refinery margins. So what was the last sentence of our report yesterday, Vincent?
What a shit time to trade.
Exactly, yeah. Okay, so on that note then, like if we were to try and be useful, trade ideas. Anyone want to go with a trade idea?
Okay, so the trade suggestion for this week would be to look at the butane propane diff in order to trade on the butane, but this is usually this is more liquid way of looking at it. So levels in butane are really, really high. That you can tell that this has been a bull play rather than genuine physical demand, because it's being pushed past the level that it is useful for blenders to buy for gasoline blending. And so it's been pushed to these extortionately high levels. Blenders don't want it. And we expect a physical correction back down. And
you say gasoline's weak as well.
Exactly, I was just getting to that. And yeah, as you say, well, actually, we do think that light ends, it's kind of hard to call which direction, but with it being, winter season and the levels being too high to buy anyway, we think it's in line for a financial correction south. Okay,
that's very niche one, but that's cool. I mean, butane is hard to trade. It's quite a liquid, but it does have these trends, and if you pick a trend, you can carry it for quite some time. So that's a quite interesting one. What would we say though for more like kind of macro trading? I guess more retail traders, investors. harder for them to trade options, but if things aren't going to happen, you can kind of simulate an option, I guess, by being like, well, look, if nothing's happening and we think volatility is therefore going to lower, you can sell puts, sell calls, have those kind of positions on, or you could just range trade. Right, at the end of the day, pick a reasonable standard deviation, and if you think that standard deviation is going to lower over time, then essentially you're just buying at the bottom of the range and selling at the top of that new range, however you define it. And I think that would be quite a good strategy at the moment. I think it looks like the financial money is quite active. That is what you could easily conclude, as much as it's been very short and kind of bouncing all over the place with not too much impact on the overall futures. They're still active, so people are still looking to trade at least. And I would say, range-bound trading makes sense until we get something. And I think it is quite, like with the Saudis putting out a aggressive price reduction. We've got a new meeting in February. I think they're going to be reviewing the cuts. And you never want to say the oil market is predictable. There are things that could happen. There are geopolitical conflicts. So I think it's a time to be kind of on the lower risk side of things. It's very early in the year. People trying to look at things over a year. There's no point rushing in and forcing a trade that's not there, and sometimes that is the best trade, not trading. So that's probably what we'd say in general. Nothing really saying product cracks, but a nice little butane niche trade. Thanks, Martha, for that. And thanks, listeners out there. We're going to end it there. Again, please like, share, subscribe, what's going on, and comment anything you'd like to see. And look forward to doing this for the rest of the year. Thanks, guys.